Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. And I've got a bit of a different topic for you today, maybe one that's not necessarily expected, but I've titled it 6 Reasons to Not Invest in Property. You know, every asset class has its advantages and disadvantages, of course, and property is no exception to that. And of course, in this podcast, I talk about, a lot of the advantages associated with investing in property. Of course, there are some massively great advantages, gearing being the primary one. And I also talk about, strategies or things you need to think about or consider or implement to make your property investments as successful as possible. And whilst all that might be very useful and valuable, at the end of the day, we've got to just make friends with the fact that there are some negatives associated with investing in property and take some steps to mitigate some of those negatives as much as we possibly can. But of course, we can't eliminate the negatives completely. And we just have to make friends with, yes, there are some negative consequences that we must deal with and come to terms with when investing in direct property. And that's what I want to talk about today. So I've got 6 to talk about. And at the end of each one, I'll talk about, well, okay, that's a negative, but what can you do to at least mitigate or minimize this negative? And then I'll try and bring it all together at the end. Okay, so the first one is it's a long-term investment, but I think it's a longer-term investment than shares are, because if you mess up the timing, you might actually have to wait 30 years. You've got to hold a property for 30 years to really enjoy the full benefits. And it really is related to understanding the concept of compounding returns. And it's absolutely crucial, I think, for any investors to really understand it. The problem is it's very difficult to visualize, how a property could be worth so much more 30 years from now. It always seems improbable. It seemed improbable 20, 30 years ago, but history tells us that's how it works. So let's talk about compounding returns then. Let's think about if we've got $100 and we earn a 7.5% return after tax, just on average, how does that $100 change each decade? Well, after the first decade, our 100 becomes $206. So we've enjoyed $106 of growth or returns, so we've doubled our money. Pretty good outcome. In the second decade, our returns double again. We earn $219. So we've got $425 in total, and that's what our investment is worth. So in dollar value terms, we've more than doubled the return in dollar value in that second decade. But the third decade is the maybe most important decade. I don't know. Your $100 at the end of that third decade will be worth $476. So you've experienced $451 of growth or investment returns in that third decade. So in the first decade, our investment earned $106. In the third decade, $451. 4.5 times more earnings dollar value wise. Now, if you apply that to property, when we're talking about often 7-figure numbers, the growth is extraordinary. And I find that, after 5, 6, 7, 8 years of investing in property, people are looking at it and going, yeah, it's going okay, but, we're not, it's not shooting the lights out. That's because, firstly, your returns aren't going to be uniform. Like that example I just gave you, we've got uniform returns. But as long as the average return over a 30-year period is 7.2%, it'll double in value every 10 years if it's more than 7.2%. But just waiting that very long period of time, having faith, making sure we buy a really good quality asset and just have faith. The problem with property is sometimes you must wait probably more than 20 years, but preferably 30 years to really see the significant impact of compounding capital growth. And that's especially true if you buy just before a flat cycle. And I did an episode back in April where I talked about why I think it's more important today for property investors to really consider property cycles than it was maybe 30 years ago, just because of that rising tide. At the end of the day, compounding rewards patient investors. And compounding is particularly important for property investors because if you think about the makeup of your return over a 30-year period, most of your return is going to come in growth, capital growth rather than income, particularly income after expenses. So because property delivers most of its return in growth, that's why you've really got to hang on to it for a long period of time to be really happy with the return. Okay, so what can you do to mitigate that risk? Well, invest in other assets. So, for example, if you invest in shares either in super or outside super or maybe both, hopefully then those shares can fund the full, sort of first phase of your retirement, call it the first 10 years, 15 years, whatever it might be. And then that allows you then to hold on to your property investments for maybe another decade or two. And again, that way you'll be probably very happy if you bought a good quality investment grade asset. You'll be very happy with the amount of compounding returns that you'll enjoy over a multi-decade period. Okay, the second negative is that property can be quite hands-on as an investment. Now, I don't want to exaggerate the amount of time that you need to spend on managing your property. It's not zero, 0 hours per year. It's not hundreds of hours per year or even tens of hours per year either. But relative to other asset classes, say, for example, shares, which can virtually spend zero time dealing with them, property does actually take some time. Now, you might worry about, nightmare tenants or dealing with nightmare tenants. I just haven't experienced that. So, if you're buying investment grade property, a good quality location, and you've got an effective and experienced property manager, you're unlikely to have this nightmare tenant scenario. However, there will be times where you'll need to manage things like renovations or repairs or, any particular challenges with any tenants and so forth. Quite often there's a bit of work to do when you first purchase the investment property because that's when you find about all the problems. But once the tenant's been in there for a reasonable period of time, it tends to be quite set and forget. But every 5 years or so, you're going to have a year where you end up spending, a few extra hours managing this property. And it just is what it is. That's just property. And so you've just got to make friends with that. The best way to mitigate the amount of time that you spend, buy a good quality property. A good quality property will attract a good quality tenant, typically because the asking rent's a little bit higher. So you'll get someone, higher income earner, probably well educated, going to look after the property. They're probably going to spend most of their time outside of the property, at work or socializing, those sorts of things, and then have the right property manager. A good manager will know how to manage tenants well and therefore, won't bother you as much, of course. Okay, the third reason why you wouldn't invest in property is because the income is relatively low and potentially unreliable. So typically, your gross rental income yield in terms of percentage, the income compared to the value of the property, will range somewhere between 2 and 5% probably, but it depends on the location, the type of dwelling. So obviously apartments will tend to yield a little bit higher than houses, for instance. And I did a podcast a couple of weeks ago about the rising holding costs of property, and I concluded there that, most properties, the direct expenses, things like management, maintenance, insurance, council rates, end up equating to around about 30-35% of gross rental income. So net of expenses, your yield's going to be somewhere between 1.3 and 3.3%. So if you compare that to shares, for example, that's, relatively low. The grossed up dividend yield of the ASX 200 is around north of 6%. And it's been consistently at that level for a very long period of time. So relatively speaking, property is a income lazy asset. Now, when I say it's unpredictable too, it's not because of vacancy. Again, if you have the right property, and particularly in this very tight rental market, you're not really going to experience much in the way of vacancy. However, you could have a year where you might need to complete some significant repairs. And in that year, that means it's going to have an impact on cash flow. So if you're reliant upon property as your sole source of income, that's what I'm talking about in terms of unreliability. So the only way to mitigate this downside is obviously to invest in other assets, hold a lot of cash, do something else. Don't be so reliant or sensitive to, changes in rental income. And at the end of the day, realize that investment grade property is going to deliver most of its return in capital growth. And that's a great segue into the fourth reason you wouldn't buy or invest in property is that it's illiquid, which means it's an all or nothing scenario. You either hold the asset or you don't. Unlike other assets like shares and bonds, you can't gradually sell down or incrementally sell down an investment property. It doesn't give you that flexibility. So whereas a share portfolio, what we can do is gradually sell down over 10 years to try and spread that capital gain and minimize the amount of tax we pay. With property, it's a lumpy asset, of course. We've got to sell the whole lot. We'll crystallize a, hopefully, really large capital gain in one particular taxation year, and there's not a lot, you contribute to super and do what you can do to minimize the tax, but there's not a lot you can do with that liability. Now, at the end of the day, the most amount you're going to pay is 23.5% of gain in tax. So, of course, you keep 3/4 of it. So let's not overplay it. Like, it's not a bad outcome, but it doesn't have the flexibility that more liquid assets provide. So what can you do to mitigate that? Well, the best way to mitigate the illiquidity associated with property is, instead of repaying any associated loans, put the money in linked offset accounts, which I've talked about a lot here in this podcast. And the benefit of that is that, okay, whilst you might notionally repay all your loans one day, what you'll end up having is ready access to a substantial portion of cash. And that can obviously offset the illiquidity of property, which is a good way to do it. Secondly, if your strategy does involve, or there's a high probability of it involving, selling down an investment at some point, hopefully in retirement, waiting till retirement to sell it because you'll minimize the amount of tax, hopefully, that you pay. Just think about that. Think about the ownership structure that property might want to be in to minimize the capital gains tax. Now, don't be too focused on capital gains tax, because any negative gearing benefits typically are more valuable than a potential saving in capital gains tax, but you just got to do those numbers. So speak to your financial advisor or accountant to really work out what is the best structure. The fifth reason to not invest in property is that it's subject, probably more so than other assets, to changes in legislation and taxation. As I said, all asset classes are really exposed to that, but I think property even more so, mainly because the negative gearing thing has always been quite contentious. If you remember a few years ago, Bill Shorten, the leader at that time of the opposition party, suggested that he was going to quarantine negative gearing, so cancel it and increase capital gains tax. Look, I don't think a political party will try that again. I think they worked out that's not going to help win them election, but it's always subject to change. Probably more concerning is some of the states generate almost half their income from property, being land tax and stamp duties and so forth. And we know that tenancy laws almost across Australia in all jurisdictions have been tightened, and that can create some risks, and costs associated with investing in property. Now, in the long run, both government, state and federal, really rely on private investors to supply an adequate amount of rental accommodation. And without it, economies just can't thrive. So whilst in the short term, governments can do some things to annoy landlords and, reduce the popularity of investing, and which has particularly happened in Victoria, in the long run, there's no escaping the fact that they need a healthy private rental market, and they need to take actions to stimulate that healthy private rental market. So in the long run, I'm not too concerned about legislative changes and tax changes. In the short run, as we've seen over the last few years, these things can happen, but every market becomes more challenging. Every market becomes more difficult over time. And it's really just about having a good professional property manager to sort of navigate those changes to help you, minimize the expenses, but also minimize your risk as an investor as well in terms of compliance. Okay. And lastly, the sixth reason to not invest in property is because it's a very large commitment, both in terms of borrowing and then also the ongoing commitment to meet the shortfall between what you'll receive in terms of rental after expenses versus your loan repayments. And it is becoming more substantial. If you want to buy a house anywhere in Australia that's investment grade quality, you're dealing with a 7-figure asset. So you've got to borrow a lot, you've got to pay a lot of stamp duty, interest rates are high at the moment, the holding costs are high, and there's nothing you can do to change that commitment other than sell the property, of course. Whereas if you're doing regular share investing and you experience a temporary change in sort of cash flow expenses, you can put the share investing on hold or reduce the amount. You can't do that with property. You're locked in, so if you're going to do it, you want to do it well, because buying a substandard quality property is very risky, or buying in an area where there's not proven performance and you just hope that area is going to boom, that's also very risky. So the best way to reduce your risk is to increase your budget and get a better quality asset. Obviously, the downside to that is that you have to make a very large commitment, both from a borrowing perspective, as I said, from a cash flow perspective. Now, there's not much you can do to mitigate this downside. Of course, you can be as conservative as possible, in terms of what commitment you're committing to. So, if you've got a very, very large surplus cash flow and you're only committing 50% of that towards funding an investment property, you're probably okay. But, if you go and commit 90% of that, well, nothing needs to change very much for you to get into a bit of trouble. So I think always borrowing conservatively, always not sticking your neck out, and slow and steady wins the race. As I've shared in a few case study episodes, some successful investors, one the other week, he's acquired property over a 15-year period. You don't need to rush into it. It's really about getting the right assets and holding on to them for the long term. Now, this is a bit of a negative property episode, as I said at the beginning, which is a bit unusual for me, I guess, because whilst I've said all those negative things, I am very heavily invested in property, as I am shares as well, of course, and so are my clients. So I still see some major benefits, and gearing being the number one of them, really, being able to borrow the full cost, and your only cash contribution then is just servicing the holding costs. And as a result, that magnifies the returns, as I've proven a number of times in this podcast. And you only have to look at, the AFR rich list, for example, to work out that a lot of people either made wealth in property or are holding a lot of wealth in property. So let's follow the evidence. It does work, and it's worked very well for a lot of Australians. Every investment carries risk, of course, so it's about being rational and reasonable and facing up to acknowledging, okay, there are some downsides, trying to take steps to mitigate some of those downsides, but really probably the best thing that you can do, other than having a well thought out long-term plan, is to invest in a variety of assets. And the two growth assets being shares and property, I think conceptually almost everyone would benefit from having investments in both those asset classes. And then what you hope to do at a portfolio level is to balance out some of those pros and cons at a portfolio level so that you're sort of de-risking your strategy overall. Okay, as I've previously mentioned, podcasting is a bit of a one-way conversation. If you do have any questions for me, there's a link in the show notes to a YouTube video where you can just post your question and I'll have a go at recording my answer for you. So if you have anything like that, please let me know. Until next week, bye for now.